Good afternoon, everyone. Welcome to our panel today. It's called Demystifying Euro Clearing. I'm your moderator, Lucas Becker. I'm the markets editor of Risk.net. The name of the panel is a good one because unless you've sort of been mired in the weeds of policy for the past few years, it can be kind of tricky to work out where we stand at any one point in time. So just sort of briefly, for those that haven't been paying attention along the way, European regulators have long wanted to see more euro interest rate swap clearing done in the Eurozone. And they accelerated that push post-Brexit as LCH needed to be recognised as a third country CCP. Legislation passed in 2019, which is EMIR 2.2, included a provision to demand the relocation of swaps to the continent should regulators feel that they couldn't appropriately manage the risks from foreign CCPs, which would soon include LCH. After the UK left the EU and LCH was classed as a foreign CCP, the EC granted it temporary recognition to allow EU firms time to shift their swaps books over to Eurex. First, that recognition was granted until late 2021, and then it was extended again to June 2022. That was extended again to 2025 in exchange for the introduction for EU buy-siders of a requirement to actively use an account at Eurex. More on that in a minute. Amid all this, on the trading side, the difference between the fixed rate of a euro swap cleared at LCH and Eurex has been moving around a lot in the past year, if you haven't noticed, particularly between different tenors, which is creating some concerns around the health of the euro market. And at the same time, this year we'll also see the exemption that's kept pension funds out of the mandatory swap clearing regime since its inception, which something could have some impacts on the long end of the curve and on liquidity. So there's plenty to discuss, and it's not just me, you'd be pleased to know. We're going to have a panel, and I'm going to call them up one by one. So no particular order. First, Eric Müller, CEO of Eurex Clearing. Second, we have Gaspard Bonin, Deputy Global Head of Derivatives Execution and Clearing at BNP. We have Scott O'Malia, CEO of ISDA. And last but not least, we have Christoph Hock, Head of Multi-Asset Trading at Union Investment. All right, thanks everyone for joining today. Plenty to talk about, but I wanted to start on the regulatory side, Eric. So ESMA's decision to push the temporary recognition deadline back to 2025 came with some conditions around sort of active accounts. I just thought it'd be useful to give an overview of kind of where we stand, what that looks like, what the proposals look like, and then we can kind of go forward from there.
Yeah, so thank you very much also to the audience for being here today and the fellow panelists. It's great to see these kind of topics catching a lot of interest. And I think you outlined earlier some of the history of this proposal. I think it's important to note it predates Brexit. So 2011, the ECB tried to implement a rule where swap clearing, as essentially the second largest market in the world after the FX market, was deemed systemically relevant at the time already. ECB tried to relocate the business. The UK sued the EU in the European Court of, or the ECB rather, in the European Court of Justice. ECB lost on procedural grounds, not on content, but because by their statutes they weren't responsible for this. So now, I think post-Brexit, the concerns by the EU constituencies have grown to be too dependent on third country CCPs for what they deem systemically relevant business, i.e. the swaps, but the STIRs fall into that category as well, and the CDS, as was determined by ESMA in late 21. So with the extension of the temporary recognition to summer 25 came a consultation period that the Commission did over several months early last year to determine and hear from market participants, so how could this be accelerated, what we positioned as a market-led initiative that by now we've crossed 30 trillion in notional outstanding in January, February. So it's roughly a 20% market share right now, but obviously not enough in the eyes of the Commission. And therefore, they've come up with this piece of draft regulation in December called EMIR 3.0, and this has various components to increase the clearing activity within the EU. Parts of these elements are related to what they call supply side measures. So it was identified, and I would agree with colleagues at other European CCPs, including our friends in London, that it takes too long in Europe to get certain approvals to launch new products, currencies, etc. So that's in the proposal, that these timelines are compressed. Second, there are some supervisory elements in this proposal that are designed to, better coordinate amongst the supervisors and hand more power to ESMA. And then thirdly, there is what they call demand measures, including, I think the most important one is the active account. And I think the idea being that while the banks do a lot of activity on Eurex clearing, already the buy side looks still patchy. I think in general it can be said the buy side has done the homework on connecting. So we have more than 600 clients connected. The Commission reckons that's over 60% of those who fall under the EMIR clearing obligation. But to this date, only half are active. And that means that there are a lot of buy-side firms who either take a big risk to run against a cliff edge, or who are not preparing from a systemic risk point of view, that ultimately something will have to change. So why not start early to avoid that everyone wants to go through the same door the same day kind of thing. And I think that's the background of this active account proposal by the Commission.
Right. So we're at the stage now, obviously it's still a proposal stage, but it would be up to ESMA to set some sort of parameters, or how much, just sort of thresholds about how much to clear.
Yeah, correct. I think the process is now that there is a consultation. So the Commission proposes laws in Europe, and then you have the EU Council, which is the member states, and you have the EU Parliament, who ultimately have to agree in what's called a trilogue procedure. So that's the regular sort of procedure. Now, time-wise, there isn't a set-in-stone timetable, but I think people reckon, by this time next year, probably early in 24, this law will be signed into effect, and it's going to be effective 20 days after signing. And indeed, then ESMA is the authority to do the definitions around active and what are thresholds, etc. So that's what's on the table right now.
Great. Thank you, Eric. So we thought, it's obviously a way off, and ESMA's still got a lot of work to do to work out where to set those thresholds, but we thought it might be interesting to get a sense from the audience where you guys, if there was to be a hard number where you think a threshold should be set for how much should be required, how much Euroswap activity should be required to be cleared in Eurex on a mandatory basis. So if we could bring the poll up, and if you guys have remember to access the polling by taking a snap of the QR code on the back of your lanyards. I don't know if we could get the poll question up. Yep, there we go. So it's, what's the minimum proportion of IRS, STIRS, CDS that regulators should be required to clear at Eurex? 0 to 10, 10 to 30, 30 to 50, or more than 50. We'll come back to that one in a minute, give you guys some time to think about that. Now, it's important to note that this, it's still at proposal stage, this active account requirement. So it's, as I said, not set in stone. So interested in the industry view on where that stands. So Scott, if I could start with you, what's the industry view on the use of account, such a policy mechanism as this?
This question is, I'm dying to know the answer to, actually, because it's really the essential part of this proposal now is what is the active account? What is the quantity or the quantitative portion of this? There's a couple of ways we can look at this. There's been a discussion about a quantitative metric, and there's qualitative metrics as well people are thinking about. And trying to get that right is really important. In the proposal, there is no number, right? And so everybody's asking, what's the numerator? What's the denominator? Like what? And does the commission start small, or does ESMA start small and work their way up over time, or do we start big and say, all right, this is the justification? So we don't know that, and that's a fundamental important element to this entire proposal as we think about this and where people come out. Understanding is it the entirety of your European swap book, or is it your global swap book, and who's in, who's out? So, and which products are in and out. So we want to understand that. Make no mistake, at ISDA, International Swaps and Derivatives, we are wildly supportive of clearing. And we do understand the Commission's position on this. As you noted, we've been talking about this for a very long time. We understand where the Commission intends to go. But that doesn't prevent us from kind of getting into the weeds and understanding the details here and really making sure that we have a clearing system that continues to be safe and efficient as it is today, right? And there are supervisory questions. We have a broad membership of banks, which I think also share the view that clearing is coming to the continent, but we also have a very vocal buy side that also has some concerns about this, because the ramifications of moving their clearing positions or splitting their positions could have significant costs. The active account is an additional cost. The separating and netting is an additional cost. So we have more questions. We've submitted our response to the consultation asking about these things. We'd like to see a good, robust cost-benefit analysis around this, but that's not included yet. And we're going to contribute to this. We've contributed to the conversation over the past years, different ways to incentivize clearing. The pension exemptions coming off, will that come into scope? Having sovereign entities clear in the continent could certainly help. We want to make sure that Klaus talked about it in his remarks, having a much quicker regulatory reform. So Eurex and others can bring new products to market faster. We think there's a number of solutions that can help incentivize clearing here on the continent, staying open later to submit euro-denominated margin as well. So clearing is part of our ecosystem. We know we're going to have it. We want to make sure that it's safe and efficient, and we're here to contribute to that conversation. But the details matter, and the details of where you set that active account is going to be an important question.
Absolutely. Gaspar, I wanted to bring you in as well. What are your thoughts on all this?
The sound is pretty bad, by the way, to understand each other. But first, where we are coming from the industry perspective, from BNP perspective, is that we very much welcome the competition, this question on euro clearing and these objectives of the European Commissions, and have created all the efforts that Eric and his teams have been doing to create a clearing facility here in Germany, and the competition is created between Eurex and LCH. So that's the first very important point. Competition in market infrastructure is very important, and we will always support it. Hence the support we have in the partnership with Eurex, and we support also the other market infrastructures. Then in terms of rebalancing, clearing of euro products between the UK, let's say, and continental Europe more broadly. And here it's not only Eurex, by the way, because I see how do you move IRS, STIRS, and CDS at Eurex might be a bit ambitious in the question. The first one linked to competition, first answer, and we should always keep that in mind, should be competitiveness and making sure that the different participants are investing capital in many ways in developing innovative solutions, positive solutions for the markets, competing on financials, competing on good risk management practices, competing on all these things that Eurex is doing and all the CCPs are doing. So that should be the first one. And then there is what is the role the regulators are playing. And it's going back to the active account proposal. Obviously, it's not a new subject. So we had the opportunity to discuss this Euro clearing point for quite some time. And this active account is not did not appear like that as an idea out of nowhere. As Eric explained, it came basically, at least partially, from the fact that Eric reminded us of that a lot of people have accounts at Eurex, but half of them are not active. So a good way to trigger more clearing at Eurex would be to make these accounts active, which makes sense. And so again, in terms of regulatory action in that process, or regulatory intrusion in a way in that competition, it didn't seem to be the worst thing to do. This being said, and here I would join what Scott is saying, we need to be careful in the definition of what the active account is and on the scope of what it is touching, because there are still a lot of moving parts. We've seen, as you pointed out in introduction, Lucas, that first the basis between Eurex and LCH has been very volatile, and which shows that the market on Eurex is active, but which also shows that there is still instability, and there are things that can be there are some biases that are still there and that need to be worked on and corrected. Second, there is this pension fund exemption that will end up in June. Third, a lot of things are happening at the third. I mean, sorry, you mentioned it, Scott. Another important point is the role of public or official institutions in general in clearing, which is still not there, which would help. So there are still a lot of moving parts. And introducing something too stringent from a regulatory perspective could create additional biases in the market and could have unintended consequences, even towards the very main objective that the EU authorities are trying to achieve. So from our perspective, we think the concept of active account is not a bad one. But introducing too much of a quantitative threshold in it is not necessarily the right thing to do, at least now, considering all these moving parts, and considering just simply that if you put a threshold and you put yourself in the shoes of end users, as you were saying, Scott, and then I should let Christophe speak, but if you are close to your threshold, it means you might be forced to trade on the wrong price, on the wrong condition, on that day if you have to do something. So we need to be very careful with this threshold question, I believe.
Okay, thank you. Should we just quickly have a look at the poll? It's probably called time on that. Yeah, so 44% think 10 to 30% if we were to take a hard number, which is interesting. 27%, yeah, being quite optimistic, maybe. Any thoughts on where the numbers have come out, Scott?
I don't know. I had no idea what the market might be bid on this one. I think that's the challenge. There's lots of different ways you can come up with this, and I know if ESMA has to move forward with this, and when they have to move forward with this, it will be very tough, I think, in my opinion, to set a threshold for a variety of reasons, and then figure out how you adjust it. Do you start low, go high? Do you start high, move low? You know, there's any number of strategic ways. We're glad they are consulting, right? Yeah. This is a great time to give that feedback. As you noted, this decision gets made in 2025, so we've got some time to discuss how to, quantitative, qualitative solutions that can make this workable.
Got it. Christoph, I wanted to come to you. Didn't want to forget about you. So I know you guys trade for Euroswap solely at Eurex, so the requirement is kind of less directly relevant on you guys. But putting yourself in the shoes of an EU fund who might be currently trading at LCH exclusively and might have to start putting some flow through Eurex as a result of this. Could you sort of tell us about the practicalities of that? Is it practical to run two accounts? What kind of costs come with that? Because I know you're on LCH, but for a different currency.
It's first point I would like to make for us, central clearing delivers not only in the products where we have a mandatory clearing, but also for the ones where we have a voluntary clearing delivers significant advantages for us, and not only for us. We are a service provider to our investors, to our clients, and that's really the perspective we have to look at. How do we generate for our clients the biggest value? And we found this was already more than 5-6 years ago that central clearing is definitely a path across all asset classes we would like to go. And back in 2018, 2019, when became pretty obvious that Brexit will happen, what potential consequences are, we did an in-depth analysis to see whether it's beneficial for us to stay for the time being in the UK with LCH for our euro-denominated interest rate swaps, or whether we would like to be the first mover shifting the entire business here to the continent into the EU 2027. And that's actually a decision we have taken not only for interest rate swaps, but also for our CDS business. So it's clearly a decision pro EU 27 with euro-denominated interest rate swaps, having shifted the business to Eurex, and in the CDS space, we have LCH Paris as found as our counterparty. Coming back to interest rate swaps, what are really the benefits we see, and can we quantify it, or is it just some qualitative thought? So we went through a more than 6 months really in-depth due diligence, looking at the fee structure, looking at liquidity of the products, looking at what you mentioned, basis, what might happen with the basis, how does it cope in a stress scenario, in a kind of normal market pattern. This was one part of the analysis. And on the other hand, we are also a fairly decent sized player in listed derivatives. So trading bonds, trading OATs, trading BTP futures is core part of our business, and that's why we came fast to the conclusion that when having netting effects between, on the one hand, euro swaps, and on the other hand, listed derivatives, delivers by far a bigger advantage for our clients, rather than having a potential netting in the interest rate swap space between euro, between dollar, between between Swiss franc, between yen. So this was, as I said, one of the outcomes, and the other part we were looking at what we can deliver as collateral. And we have a few CCPs across the globe which have a very strict, very limited collateral metrics where we have to deliver a highly valued AAA paper or even cash. And then we have, on the other hand, the Eurex, for instance, where we have a breadth of more than 10,000 plus underlyings we can deliver to Eurex as a collateral. And that's from our perspective on top of the netting between listed and between OTC. Collateral metrics was for us also one of the key decision maker finally for our choice. And our base assumption was already back in 2018. We will generate significant advantages for our investors by having this shift. You remember Mr. Rollet, he came with a big FT article talking about the $100 billion gorilla, that massive cost will be embedded with shifting business here to the continent. This was not our experience at all. And that's why we highly appreciated over the last couple of years the development we've seen with the Eurex now, regardless what numbers you're looking at, market share between 15 and 20%. It's an evolutionary journey we are on. It's not the kind of big bang, which is, I guess, pretty well done by the regulators to have this smooth transition. And looking now at EMIR 3.0, the EMIR refit, which will come in play, and also implementation of an active account. This is, from our perspective, another piece of the entire puzzle to further develop the ecosystem we have here on the continent when it comes to euro-denominated interest rate swaps. So therefore, from our perspective, box absolutely ticked that we acted in the very best interest of our investors, generating additional benefits for our investors, and we were very happy having made this decision about 5-6 years ago.
Great. Thanks, Christoph. Just wanted to quickly go to an audience poll on this topic, because really, again, curious to see what you guys think. So the question, if we get up there in a second, is how would you approach clearing if an active account requirement was in place? Would you, no matter where it's set, would you, I guess I'll bring the options up in a second. Would all trading, would you put all trading through Eurex? Would you trade mostly on LCH and keep the minimum amount in Eurex? Do it the other way, so trade mostly on Eurex, but keep a little bit in Eurex from time to time, or split things equally? Yeah, very curious to see where this one goes. We'll come back to that one in a second. Just before we do that, just really quickly, Eric, I wanted to ask you, we've talked about the thresholds and how they're being set. Obviously, that's a big unknown at the moment. How would you prefer to see them set? Would you prefer to see a nice round number that's clear, or as has sort of been intimating, it might be a bit more kind of, not going to say woolly, a little bit more kind of flexible about how that calculation is going to be? How would you prefer to see it?
Yeah, so I think the idea of an active account is an important one from a systemic risk perspective. So as I said earlier, it's never a good idea in anything that everyone goes through the same door the same day. So I think the objective must be that people don't have just a second car in the garage, but that they check there's gasoline in the tank, the tires, have enough air, and that people have driven in a car where the steering wheel is on the left side rather than the right side before. And that's, I think, the incentive that I would emphasize from a risk perspective, it must be ensured that activity is not just, oh, I did a single trade, but as we all know, and that's why we test so much when we do system upgrades, introduce new products, there are things where the plumbing needs to be optimized, there are third-party vendors involved and all of that. So I think it's a good idea to think about activity levels that are meaningful in the sense that it's not just a test trade. Yeah. On the other hand, I think the answer, as we've heard from Christoph, might be that, smaller buy side may decide, I don't like the complexity of dealing with 2 CCPs in one currency or product. So I think kind of independent where you set the threshold, that some will say, okay, in order to keep the operational efficiency, because I'm not, BlackRock, who may have the means also in their middle office and back office to digest many CCPs and work with all those different processes, that they conclude, okay, I want to keep it simple. But I think what holds them back today is, and I'm a little puzzled around that, is that they think, oh, it may get pushed out just another round, and maybe it never happens. So when you compare that to the words picked by the EU Commission, that's why I'm puzzled, because there are, in no uncertain terms, do they say that the current sort of setup where the vast majority of euro exposure in swaps is still handled by a third country CCP, it will be tolerable. So I don't, and if you start from there, then it really becomes more of a technicality to define, how can you have a pathway to reaching a threshold where we can ultimately get a permanent type of acceptance for that CCP. And you heard me say that before. I'm not advocating that we are the only permissible CCP for Euro swaps. We like competition. That's why we have, and that was mentioned by Gaspar earlier, that's why we have pioneered a program for a market-led transition. But I fully understand and realize that in the eyes of the Commission, it's from a systemic risk perspective, we haven't gotten there, and the clock is ticking to June 25. And I think that's why the industry would be well served to work constructively to what hopefully is a number, that satisfies the people within the EU that are worried from a systemic risk stability to have too much outside their jurisdiction and, central bank in the end. How can we get them comfortable to shift towards a more permanent form of equivalence? So that to me is the important goal that we should have in mind. And this is an interim step where, I think, yes, this needs to be discussed with the industry, but in my eyes, it's unavoidable to not be in a situation where the EU will put out tougher weapons that, we wouldn't like as a global CCP to see, because we do business in other jurisdictions, and we do think there should be permanent forms of recognition.
Got it. Understood. Do you want to go to the poll results? Curious to see how that's played out. It looks like it's fairly even. Yes, so slightly winning, trade mostly on LCH and keep a minimum amount in Eurex, and all trading to go to Eurex. So, depending on where you sit, that's any thoughts on that quickly? Is that about where you thought things might come out?
I think both Eric and Christian did bring up very good points. Size matters, and larger entities are going to have the greater capacity to adopt this sooner. And then you have to look at it through your own lens. Like, what is your business? What are you trading? Who are your clients? I think those are both are great points.
Yeah. Okay, great. I wanted to move on just quickly. Gaspar, you mentioned CCP basis. So, amid everything going on the regulatory side, the CCP basis has really moved quite significantly, specifically between the different tenors. I don't think we've got a chart. I'm hoping we can bring it up just to show the audience the kind of the movements. But in case it doesn't come up, the long end sort of went quite negative. It's tracked quite closely together, and then at this sort of early mid last year, the long end fell quite negative, and the 10-year has gone quite positive. So for the first time, you've had this quite shock to the basis system. Now, obviously, a lot happened last year: rate rises, regulatory changes, as we've talked about. But Gaspar, I wanted to ask you. I mean, what do you think? A, might be the driver. I know it's kind of hard to say, and B, what does this kind of activity mean for the euro, the health of the euro sort of clearing market? There we go. So if you look on the right there, it's gone a bit crazy.
Okay. Yes, indeed. I mean, we've seen over the past 18 months the basis move quite a lot in opposite fashion on the 10 years and the 30 years, while at the same time the market share, I think of Eurex under your control, Eric, staying relatively stable and resisting well during this period of high volatility and maybe lower liquidity, as it was alluded to in the previous panel. So again, for me, it's a sign that there is activity. There are people who are willing to pay the basis, one way or the other, and there are some actual fundamental flows that are definitely convinced that they want to clear on Eurex. I mean, Christophe, your explanations were quite enlightening to my point on competition. All the positive things you see in what Eric and his team has built, but there is also this imbalance that is varying, that is difficult to understand sometimes. And I know, again, Eric and his team are trying to work with the market to understand better and better where it's coming from and how to stabilize this, right? But for me, this work is clearly a massive priority because it creates a sense of instability on the liquidity. And it's maybe the opportunity to point out on something we already mentioned twice, but which is the clearing of the official institutions in Europe, which is even more important with the pension fund exemption coming in June, because we know that the flow from the pension funds obviously is quite directional on the long end, and you don't have so many natural flow to offset that. You have it's mainly coming from the people who want to fix their rates for long-term borrowing and then progressively replace that by actual issuance. And you have doing that some corporates who will need those swaps, but they are not clearing today. And you have the official institutions. And what is interesting is that these official institutions are part of the European authorities in the broader term, that are sponsoring this rebalancing of euro clearing on the continent. So if we seek a bit of consistency, I think it would be good to see those institutions step further into clearing, into systematic clearing. I guess they might make the choice to do it at Eurex, again, for the sake of consistency. So for me, that's important. That's important also for the stability of the liquidity and of the book of Eurex and the book of all the clearing banks that are supporting Eurex at the end of the day, for the long run. For the 10 years, it's less obvious. You have a lot of different factors there. One thing that can help, and I know again Eric is working on that, but is to internationalize further the market participants to Eurex, and it's the case for all the EU CCPs. I think they shouldn't compete for the European market and European market participants, but they are here as European market infrastructure, and especially in OTC derivatives, which are global markets, to compete for the global market participants and attracting US market participants, not necessarily across currencies, which might be quite a challenge, at least for the foreseeable future, but on euro, it's something that should definitely be a target and could help stabilize the basis, I would say.
Okay, thank you. I know we've only got a few minutes left, so I want to rattle through a couple of quick questions on this one. Christoph, from a trading perspective, just curious, there's been quite wild moves on the basis, but how does it affect you guys? And from a trading perspective, how important is it? Stability in the basis for you guys? Cost
of trading is definitely not only determined by the basis between Eurex and LCH. So when looking at volatility in general nowadays, fixed income volatility, beginning of the week, rates volatility was at the highest level since the Lehman crisis back in 2007, 2008. We have days where Bund future trades has a trading range of 250 ticks, and interest rate swap typically is a product where also in these volatile markets you get fairly aggressive bid offer spreads for decent notional. That's, by the way, when looking at you've shown the longer dated tenors. 30 years where basis was pretty stable. I guess you have in this ecosystem pension funds rather than investing in bonds, going into more liquid interest rate swaps. So at the end, the basis is determined by the various players in the ecosystem. You have payers, you have receivers. Here, over the last couple of months, that's our observation, especially on the bank side. You have seen a need for putting hedges in place against higher rates, and that's our interpretation why basis was widening slightly. But as said, the 3.5 basis points, and that's definitely not the determining factor whether a trading strategy is a successful one or not. It's one part of the cost of trading, but clearly not the only one.
Yeah, and my 5 cents, I think. Thank you, Christoph. Spreads. We have achieved with the partnership program, they're exactly the same. You open up a Bloomberg screen, you see the same spreads. The prediction of many people in the UK was when we started, they discouraged us to start. It's an impossibility that you can have an alternative liquidity pool because the magnetism of having everything in the same pot is just so high. And I think with the 20% market share, we've proven that you open a Bloomberg screen, spreads are the same. They've widened in the market environment, but they've widened by the same thing. And then basis obviously is one variable as Christoph outlined, but I think the big question is there a structural basis? And that's where our clear answer is we don't see any reason why there should be structurally a basis, because who is issuing euros? Well, that's the governments, corporates were mentioned, and in between are the European banks. So who houses European sort of exposure? Who has appetite to hold exposures? There's insurance firms, there's pension funds, there is the buy side, and we do think that Europe, more broadly, has a very healthy ecosystem, and I also agree with what Gaspar said, but we don't stop in Europe. We have a CFTC approved model, so we are onboarding US clients at a high rate. We have a license in Japan, so we're building out that international element as well. So that's why I think this is noise for now, but there's no reason once all these other entities come in and the official sector was mentioned, I'm convinced there is a healthy balance of payers and receivers to be had on our platform.
Okay, thank you very much. We could talk about this for hours. I certainly could. We talk about it on our desk all day, but we're going to have to leave it there, unfortunately. We've run out of time. Thanks for the panel. Really appreciate taking time and your views, really interesting chat. Thank you everyone for listening in, and yeah, we'll leave it there. Thank you.